tax concerns and economy concerns, and just what's been going on in general in the real estate market, and then as well as in the overall stock market, and what's been kind of shaking down in the different stock charts, if you guys want to dip into that. But primarily this show is driven by you guys, so whatever questions you have, put them in the comments and we'll go where you take the show. I like to start with a topic to sort of gather the questions under a header, but you guys take the show wherever you want. It's your show. I'm just here to serve. So, sorry about all the boxes and stuff. I'm about to move. I'm, 3.5 weeks away from being homeless. I'll have sold this house and my new house closes September 1st. So for 6 weeks, I'll be living at the cottage. My internet may or may not be adequate. We're going to find out, given that it's quite rural, living on the beach. So get to live on the beach this summer. It's exciting. July 15th, I will be living at the cottage on the beach, and it'll be a good time. So today, what happened today, guys? Has anyone watching at 2 o'clock when the Fed released their guidance on what they were doing with tapering and inflation, etc. Jerome Powell spoke today at 2:30, and then he fielded questions. I didn't watch the whole thing, but I watched the highlights just because I like to keep apprised with what's going on. Some key things I think out of that were clearly interest rates are not going up right now. They seem to believe that the current formula for the CPI is within guidelines of what their targets are. It sounds like a lot of bullshit to me. I don't think that we're really seeing, I don't think we're really seeing inflation being under control. And I think that the prolonged low interest rate environment that we're in now is not healthy. For investors like myself, I will benefit from the debt. I love that I have multi-millions of really cheap bank debt at 2%, right? So I'm enjoying this inflation because I'm levered multiple times to 1, right? So my money is growing with inflation. It's growing quite a bit. But let's talk about how inflation plays out in most businesses and plays out from a tax perspective, because inflation is really just a government tax, right? Like if you inflate everyone's assets 50%, first off, anyone who doesn't have assets, they're screwed. But if you have assets, your ship rises with the tides, right? So that's a good thing. The bad thing is, let's say you make 100 grand on the appreciation of your rental property. If you go and sell that rental property now, or that stock, and your stock goes up, whatever, your business, your asset, your gold, whatever, your crypto, if you sell it, you lawfully have to claim a capital gain. And in some cases, it's not even treated as a capital gain. In some cases, it could be your active business income could be at 54% tax, right? There are debt structures I've seen where that's the way that the income is treated, right? So depending how you structure your tax setup, it could be anywhere from 25 to 55% tax here in Canada if you're in the higher income brackets on that income. So now your buying power to buy something else has gone up. That $100,000, compensates you. You've rose with the tides with the inflation that's been created. But the downside is, of course, now you're going to lose 25 to 50% of the $100,000 gain. The government's going to take 25 to 50,000 of the $100,000 gain. So it's really just a way for the government to raise money. Otherwise, like if there was no inflation, your buying power would be the same as now that they've inflated the buying power of all your assets. You're not really any wealthier. You're actually less wealthy because that 100 grand you rose with inflation, you now only have, let's say 50 grand of that left over after tax. You actually need 100 grand to buy the same amount of stuff you needed to buy before. So now you have half the money. You're up 50 grand. You're like, ooh, I'm up 50 grand. In a high inflationary environment, people tend to be very, excited because the economy feels like it's growing. It's not really growing. It's inflating. It's not real. Your buying power is actually not up. But anyway, so not good. I would like to see interest rates rise. I'd like to see it be a little bit more healthy for the economy. We're seeing a little too much growth. I think it's not sustainable. The levels of growth that we're seeing, especially businesses that are highly tied to low interest rate. So like high margin businesses like real estate. Real estate is just on fire. Low interest debt forces people to go and borrow. Like when money's this cheap, you can't not go borrow it. So people rush in hordes to go buy real estate. And because real estate's such an easy thing to lever, you can buy it 5% down, 20% down, 10% down. But very often you're putting between 4 to 20 times the bank's putting 4 to 20 times the money you are into the deal. So it really becomes the bank's problem at some point. And so that's another reason why I think real estate can't really crash here in Canada with these, when we talk about recourse versus non-recourse mortgages on last week's episode. But let's talk a little bit about, we talked a little bit about taxes and inflation woes. We had a guidance come out here in Ontario about the inflation rises we can lawfully deliver to tenants. So in the landlording business, you're capped on how much you can increase rent each year. And I believe it was 1.8% was the cap again. But then they've gone out and said the target for inflation is 3.2%. So that to me is a big, screw you to landowners and landlords and anyone in the rental business, because they're saying, hey, your hydro's going to go up. And by the way, hydro's gone up 8%. Your property value 30-40% in most cases in Southwestern Ontario. That has dangerous effects on your bottom line in the rental buy and hold business. I'm not at all attracted by buy and hold right now. I find it, the only reason I haven't sold my properties off and I'm still waiting is because firms are coming in, large institutions with all this cheap debt, and they're buying up houses. If you've been following my Instagram stories at Mike Rosehart, you'll see earlier in the week, I posted about some of the large institutions coming to London, Ontario, and Toronto, and some of the smaller cities in Southwestern Ontario, and they're looking at buying 200, 300, 400 homes. That'll gobble up a lot of the available inventory, right? And when those funds come in and use the cheap debt that they're borrowing at 2%, and then the equity that they're getting, extremely cheaply in the market, they're going to find themselves in a situation where, because the way funds have to buy, they have to buy everything on side. So they can't buy a rental property with a nanny suite that's somewhat illegal. They have to buy stuff that's licensed with the city. Every year it gets inspections, blah, blah stuff. Those kinds of properties are very far and few between, especially in markets like London. It's hard to find everything on the up and up with, recent ESA and fire inspections. And just most landlords don't even get, I think it's something like 80% of landlords in London, Ontario aren't licensed. If you look at the number of licenses actually granted, almost all the landlords don't follow the licensing program unless forced here in London. And if you look at other municipalities, it's very similar. Most of the properties are rentals. More than half of properties in London are rental properties. And more than half do not have rental licenses up to date, right? So it just, anyway, my point is that those properties that are premium, they're going to have to overpay for those properties, and it'll still make sense from their return on equity perspective, most likely. Also, we've got a huge influx of immigrants. Trudeau has a plan to bring in 1.2 million people into this area, and you got to remember that, Toronto, Brampton, Montreal, and then London has a huge subsect of Indian and Chinese populations as well. That will then typically, when you immigrate people of a certain culture, they want to go where their friends and family are, right? And so what happens is the concentrated pockets of ethnicities tend to grow the fastest when you bring those types of immigration policies into perspective. That will force rents up because it's simple supply and demand. It will also force house prices up. Inflation also will force house prices up. Cheap debt will force house prices up. Interest rates will rise as we see that the economy is recovering, and they have to basically stop the tapering and bring back inflation a little bit, right? It's going to run wild. They're going to try to manipulate it as best they can. But what we will end up seeing is that businesses, right now, they've been hesitant to pass some of those increased costs they've been sort of suffering. They've been hesitant to pass those on. In a different, more balanced market that's coming, now we're starting to see this summer, a more balanced market with all of the stimulus that's been pumped into the economy. We're now seeing businesses saying, okay, I think I'm comfortable to pass some of these costs on to my consumers. And that's when you see the inflation. Right now, what we're seeing is it's costing businesses a lot of money. The stimulus has, more than paid for that, but the stimulus is ending now. And when the stimulus sort of ends for the businesses, they then pass those increased new costs on. Look at the cost of lumber, steel, any of the raw materials, food, anything, gas, everything's way up right now, right? Considerably more than the CPI index, which is heavily weighted to consumer tech. Again, very lagged to the raw materials, right? So I think that, in the third and fourth quarter, we are going to see some passing on of costs. Business owners are going to start passing some of these raw material costs on to their consumers. And that's going to have major impacts on inflation. The inflation is delayed, right? We've now admitted that on a monthly basis, we saw 4 and 5% real inflation. If you annualize that, that's insane. We're seeing 20 and 30% inflation. That can't sustain. And the businesses are just recovering on stimulus. they aren't in a position to pass those costs on to their consumer yet, but it's coming. And that's when real inflation happens. Right now, we have businesses that are, underwater, but being stimulated and they're still surviving on those huge stimulus loans that we got here in Canada. I believe the US, they gave similar types of stimulus loans to businesses. That eventually dries up and that well runs out. And businesses are like, okay, if this is the new normal, if an air conditioner is now $2,000 at cost when it was $1,000 a year ago, and that's an actual example I'm giving you of someone I know who runs a small HVAC business. Just so many examples of things that are just way higher in cost. And right now, the businesses have been just eating into their profit margin to sort of in fear that people will not buy the goods, right? They're afraid that if they raise their price, that they'll have less volume. But what's going to happen in the third and fourth quarter as the economy, continues to roar, people will feel more comfortable paying these higher prices. They'll basically have no choice. Business owners will have to pass on or go through another wave of stimulus, which I don't think is necessary or warranted given the current data that we're seeing, especially around COVID-19 infection rates and around what we're seeing with the vaccination rates. It's not a deadly virus for people under 30 years old. It's almost comparable. If you're under 20, it's almost comparable. Getting COVID and getting the vaccine have almost comparable negative ramifications. If you're older and you're in that risk group, the vaccine makes a ton of sense. You should go get your vaccine, 100%. If you want the economy to go back to normal, probably get your vaccine. But there is a huge group of children who don't need to get it, who've already got natural immunity because they had it already. And that's a big challenge, I think. Anyway, I think we're rounding the corner. There'll be more variants forever. I don't know if it's a new normal now where every flu season we just, there's new variants that kill old people and people who are at risk, which is, millions of people have died every single flu season. Millions of people, if you look at the data. More so, with COVID-19, and I think some of our efforts with lockdown may have helped a little bit. I don't like the approach. I don't want to get into the politics because that's not what I designed this channel to do. Though I could talk about whatever I want on my channel, I don't want to get into it. I don't want to get political. I know some people are super heated and supercharged when it comes to some of the stuff that's gone on in the last year. And who am I to make these calls? I think the government could have definitely done a better job at creating COVID treatment centers, keeping it out of hospitals. Thousands of people died because they were too lazy to create centers where they could have treated, people and kept people having surgeries and et cetera, so forth, away from and getting infected with COVID. But laziness, right? It's easy just to lock everything down. It's hard to actually make a plan and build things in a short order of time and actually put together, resources and centers and things like that. It's just a lot of work. And so the government's like, what's easiest and safest for us? Well, politicians like, let's just lock everything down. Basically go on vacation. Not go vote on things, not do our jobs, just lock it all down, right? And so they chose the easy route. It's human nature. We're relatively lazy creatures. We tend to take the easier path in general, and we tend to be most self-interested, unfortunately. I really just saw a comment come up, and I really want to address that one because I love it. Jay Powell just said there's zero inflation. We're all good. 30% housing increase year over year is normal. Yeah, I mean, it's worse here in Canada. We're like 45% year over year housing. Everyone I know that was a real estate investor is a millionaire. Like there's multi-millionaire. If I go back to my real estate, networking groups from like 2017, everyone there is a multi-millionaire. Like if you're not a multi-millionaire, you're holding a couple of properties back then, you did something wrong because you just buy anything, burr it or not. Buy the worst deal, do the worst flip you've ever done, mess it all up, and you'll still make hordes and gobs of money just because of all the money printing, right? But you got to remember, it's not just, I think housing is disproportionately affected because it's not a good representation. Okay, so I hear people's argument on the side of some arguments I've heard are like, hey, housing is 40% of the average person's budget. And so the CPI index is very flawed in that the majority of what people spend their money on, rent or mortgage payments like housing, that's skyrocketing in price over the last 3 years here in Canada. And yet inflation is looking at people, like typically what they're looking at is, well, they're not accurately weighting how much rent and housing is for the average person's spend to determine how much it actually is affecting the average person. But further, they're dragging in numbers like, Sally's been renting the same 2-bedroom apartment for $700 a month for 25 years. And she's throwing at the statistic. But what about everyone who's new into the market, right? So there's a huge flaw there on one side. On the other side, it's really a function of, or there's some other things coming at play here. One is that interest rates are at all-time lows. And if we were to jump interest rates back to even early 2020, like January 2020, would have huge negative effects on the price of real estate. People could qualify for about 20, 30% less. So you got to remember, a lot of the current pricing is a factor of cheap debt. And do I think there'll be a correction? Not necessarily, but I think we would see a slowing down. We would stop seeing people just irrationally bidding, right? When they can't afford to buy that house for $800. Now they have to pay $700 for it. And so there's just less buyers in that pool. Right now, there's just a plethora of surplus money, an inflation of all of the assets, and cheap debt, and then on top of that, a supply and demand issue, because the government's basically shut down all supply creation. There were no builds happening during COVID. There was no increased densification. All my duplex, conversions and additions were put on hold for like 8 months. The city of London didn't even get back to me on permits for I think one of the projects they delayed it for like 8 months, just reviewing the plans. COVID. That was the excuse to not do work. I don't know what they were doing at City Hall. Everyone was still collecting a salary. I'm actually not sure why it was such a delay. They just would find basically any deficiency on your drawing, even if these were engineered drawings stamped by someone who's a draftsman and all that, BCIN, all that stuff, engineers. I didn't even draw them, and they're finding, technicalities. Oh, we didn't see this here. We didn't see this text on it. And then it goes into a pile that has no return on time. So there's zero SLA. There's no, basically, they don't have to get back to it at any given time. They can take as long as they want. Anyway, my point being that supply was at all-time constricted lows. We needed supply more than ever, and then COVID basically just crushed supply. And then on top of that, it crushed the production of raw materials like lumber, like forestry, mining, etc. All that was slowed down, right? So then, entrepreneurs being entrepreneurs jacked up in those industries, jacked up the prices of those raw materials. And then we just had sort of a trifecta of raw materials going out of control and building costs being double. In many cases, it's double right now to build the same house a year later. And then, more difficult to do with delays. So that's created a huge supply side issue and forced prices up. So a big function of the real estate pricing catastrophe that we're in now, for anyone who's trying to get in for the first time, is a function of the cost of raw materials right now. Steel, lumber, all of those raw materials are 2, 3, 4, 5 times what they were a year and a half ago. We're seeing 400-500% increases. That is going to trickle down and have effects on the CPI, on the Consumer Price Index. It will take time for that to trickle down, for business owners to pass a lot on, and then I'm sure there'll be a bit of denial. Like Jay Powell's going to come out and say everything's just fine. Those who are actually in the field, looking at the cost of things, can see that it's not just fine. It is a problem for the average Canadian, the average American. It's going to be a problem when, to build a small average house, it's like $500,000-$600,000. That's kind of where we're getting to. That's a problem. And then add on that immigration, because people are wanting to still escape. And by the way, immigration was put on hold during COVID. There was a lot less applications accepted. So there's a big pent-up demand for people who want to immigrate to the great Canadian nation and the United States. And so there's a huge pile of demand that's going to be released and not enough supply to eat it up. So short term, I'm still super bullish on Canadian real estate. Long term, I'm pretty neutral on the price of Canadian real estate. I still want to sell my Canadian real estate because the buy and hold piece, that business ecosphere, is not conducive. It is not supportive of landlords at all. It's not conducive of making a profit. We have huge rent controls here in Ontario. It's very much the tenant base is more entitled, I think, than I've ever seen before on average, and it's just not a profitable environment. It just isn't. The buy and hold game isn't. The flip game, 100%. I think if you're speculating and you can hold and you can sort of break even, I think you can make some money in the short term. So there's still, I don't know, I'm sort of mixed. I think my experience is highly clouded by the fact that I value my time very highly, and I've had a number of negative experiences dealing with I've had so many tenants that I've dealt with everything from floods to fires to death to everything at my properties. I've dealt with something before. so many times I've been called by the police because property manager didn't answer. There's a problem at a property. You can't pay me enough to deal with that stuff, and no manager is competent that I've been able to find to properly deal with all of that stuff, right? And then if you can find someone that you can get to properly deal with all of that, it does it cash flow enough to make it worthwhile, right? So that's something you have to kind of figure out for yourself. And I think for the average person, it probably does. At my stage in the game, I have a high income set of skills where I can make $10,000 a day trading, more than that, trading. And so would I rather, deal with tenants all month for 10 grand, or would I rather make 10 grand a day trading? And if I could take the equity out of my real estate portfolio and trade with it and make 20, 30, $40,000 a day, do I even care about money at that point? There is no amount of money that is equivalent to sacrifice on my quality of life. And real estate is, if you're owning B and C or B and C rentals, so I'm talking like average or lower average income rentals, as well as student rentals, it's a hard grind. Like, it's not passive or easy. So for someone just getting started, yeah, I mean, real estate's a fantastic way to build wealth. You can get in with 5% down, 20% down, refinance your capital if you buy something that's distressed, that needs your love. You need to fight with tenants and fight with the property and fix it up and all that stuff. You go through all that crap. Ideally, go buy properties that are having issues with the city. That's the best kind of deal you can ever get, is go in there and find someone who's just got a deficiency order from the city. They got, they have to put egress windows in a basement. They got a ceiling headroom restriction issue. They got to, imagine trying to fix that. That's a huge renovation, right? And so you can come in there and solve that problem, and those are the best kinds of opportunities. They're the most headaches, but if you're trying to build wealth, I did a lot of those, and it's a fantastic way to build your net worth. Hey, super chat. Thank you, Randy. Randy says, and by the way, if you super chat, because I don't put ads on the channel now, this is literally the only way I monetize. Although for some reason YouTube keeps putting ads on. I have them off completely, but for some reason they'll sneak the odd one here or there. I don't watch my own channel, so I don't know, but I hear it from people who are watching it. So Randy says, what's your take on buying pre-construction in phase 1 or 2? Technically, you're buying at a discount. Generally, it appreciates. No rental costs. HST sucks, though. So Randy, my understanding is if you're buying in the right price range still, in some areas you can get the HST back. I don't know if they've updated the rulings, but like when I built back in, so I did a pre-construction build. I was the first one in the whole subdivision. I was the very first deal inked with Drew Lowe here in London. And I think I got my build for $299, which it's probably worth $700 or $800 now. It's a shame that I sold it for $415, but hindsight is 2020. I think I took that capital and then rolled it into multiple other deals. So I'm sure that I'm doing just as well, probably better by having rolled it multiple times. But so one, I'll start with, I like pre-construction because even if the market doesn't appreciate, even in a flat market, you get a natural rise just by taking the risk and being first. Oftentimes, the early developments don't get enough exposure. The roads aren't even often developed into the subdivision. And so you'll typically get a first mover advantage or a early adopter discount. So there's something there. It's not a lot. It's typically between 1% and 5% from what I've seen between phase 1 and phase 3. So yeah, if you can get in early, that can be awesome. Another cool thing is when you're in the starting phase, when it was a more balanced market, you can go in there and negotiate a little bit deeper discounts. Like I got granite counters thrown in. I got a bunch of extras, a 9-foot ceiling upgrades. I got a whole bunch of, I got a free concrete driveway, and I got concrete, back patio. I negotiated a ton of stuff in that was, extras for free because I was the first one to sign. And there was discounts. I think there was a $15,000 discount to be the first one to sign. And they ended up taking a lot longer to get the services in there because mine was the first house. I ended up having a closing date that ended up being almost, I think it was like 7 months later than originally. And I got put up for free in one of their townhouse condos, which was a cool story actually, for another day. But ended up being a great opportunity for us. And by the time we had moved in, I think I was already up like 15% on the pre-build. And it was tax-free because it was my primary residence. I think I was HST exempt because I stayed under the limit. And yeah, I mean, it was a fantastic opportunity to do 2 pre-builds. And there's still a fantastic opportunity. I almost pulled the trigger on 3 of them in London here for $599 about a year and a half ago. And they're $1 million each now. So what a shame that I didn't do it. But at the time I was like, the cash flow isn't there. Do I want to carry these things if I have to close them? And at the time I was like, I don't know. It's a lot. And I had a lot on my plate, so I didn't do it. But Yeah, they're definitely an opportunity. They're really hard to cash flow. So the idea is that you assign it. In the best case scenario, you move into it, live in it. It's a tax-free sale down the road after you've lived in it. Um, Even better is if you can assign that contract before it closes. So do like a 1 year closing, assignable, negotiate that your build contract is assignable, and then assign it to someone else before closing when it's into phase 2 or 3, ideally. Just as your house is being built, they'll be starting on selling out the third phase. So you'll sell against that third phase pricing, which is of course more because they've developed the area, and then plus any appreciation, which I wouldn't count on. I'm not a speculator, so though I do think we are going to have another bit of appreciation bout coming up here. In the same, I could be just as wrong. Interest rates could turn, and we could see 1% rise in interest rates, and we could see the real estate market go flat. Like in Toronto from 1990 to 1998, I think there was almost no appreciation at all. You buy a house, and 9 years later, you're worth the same amount of money. London had for a decade the same house price. You can look at house prices in the 90s. My house now, this one really interesting. They built this house that I'm in now, I think in 1989 for around 300,000. And I think in 1999, so 10 years later, it sold for in the 300s still. Wild to me. And then from 1999 to 2019, when they sold it to me, in that 20-year span, they made a double in the 600s. And I just flipped it, I not flipped it, but the market's just gone crazy, and I'm well over $1 million now for the house, right? So I've been lucky that in the last 2 years, it's not typical of previous years' performance. And so I'm aware that we could go back into a market that's balanced, where the money printer stops going, right? And we have a situation where, like we had in the 90s, like we had in London for most of the 2000s as well, until 2010, 2011, 2012. Very common in London to see the same, you put some money in renovating your house and you sell it 10 years later, you maybe get you may be kept up with inflation. If you're lucky, you got 2-3% a year, right? So that's possible that we see that again, right? So I don't want to bank on appreciation. It could happen. The way things have been going, it could happen for a bit longer, but eventually, when no one thinks the music's going to stop, that's when the music stops, and you got to find a chair to sit on, right? So when everyone else is bullish, be bearish, be fearful. When everyone else is greedy, be fearful. When everyone else is fearful, be greedy. That's been something I've tried to live by. In London, when people were not bullish, I was bullish, and now I'm less bullish than I ever have been. I will still flip, but yeah, good question. I do like pre-builts, especially if you can assign them. If you're just doing them as an investment property and you're planning to hold them, the HST sucks. You're planning to flip them, you have to hold them to get the HST back too, right? If you just flip it right away, then there's HST, I believe. So, yeah. Let's do some Q&A, guys, because 28 minutes of Q&A. For 40 people watching, if you're enjoying this content, getting anything out of this, hit that thumbs up. That'd be cool. Hey, Mike, good to see you on. Love and Tall, good to see you on as well. Legend is alive. I'm alive. I'm here every week for the last 3.5 years. I've never missed an episode. Christmas, Boxing Day, my birthday, I'm always live. Every Wednesday, 7 to 8-ish Eastern Standard Time. Hey, Mike, anywhere I can get 100% financing in Canada? Port City Trading Desk, there are lots of creative ways you can structure a deal to buy with no money down. You could find a JV partner and put no money down. You could, from a completely debt-structured perspective, there are people like Calvaire Mortgage, people like Finley, the Finley Mortgage team that McKeever talks about, that are sort of alternative lender funds. And I use Calvaire Mortgage on one of my last deals. They will do 0 down. So if you give them all the analysis, your business plan, you can check them out. Say I sent you. If you want, check out Calvaire Mortgage. They just did my most recent Sonia flip, so they're pretty good. Their fees are not, it's reasonable for what you're getting, I think, but you're gonna have to pay a lot for 0 down. I think that I believe their program works. I don't quote me on this because I'm not 100%, but I believe if you're buying something under market value and you're planning to do a big reno on it, you can show that there's a business case for comparables that justify the ARV. You can borrow against ARV, so after renovated value, in which case you could potentially purchase something for negative money down or 0 money down, right? So it's it's key, I think, to look for those alt lenders. It's a lot cheaper in a bull market, or if you have a strong deal with, you know, good fundamentals, why bring a partner on? That if people ask me, what was your biggest regret, Mike, in doing Right Way and doing all the stuff you did, beyond like partnering with someone who, you know, I think it wasn't a good fit. The number one regret that I have was raising equity instead of debt. I'd have an extra today, if I had raised it all as debt, I'd have an extra 10 million bucks if I didn't bring any partners on. Instead, I gave all that money to my investor community. And in some cases, I got screwed, and just the human element sucks. Even if the money was the same, I prefer debt. Debt has risk because you're stuck holding the bag. With equity, your investor's stuck holding the bag. They're on title, they deal with that, or you on title together, whatever. But with debt, you have to make those payments, right? So and it's expensive to raise all of the money you need to buy a property in debt. Because you got to remember, if you don't have a down payment, that down payment money is very expensive. It can come at 10, 20% interest in many cases, which still can make sense in a short period of time if you can flip it and turn it around and refinance it or sell it, then it makes sense. If you can stabilize the property, it makes a lot of sense. What I should have done is bought every deal myself with debt. And I actually had money. I was using investor capital to help them grow to fire when I actually had the money to close the deals myself. And I had the connection, so it wasn't even a limitation. I just wanted to share the wealth with people, right? And who knows, I didn't know the market was going to explode the way it did, right? So yeah, hindsight's 2020. But I think debt is a great way to do it because you're in full control. And there's so much value to the full control piece and not having any extra stakeholders, et cetera, and so forth. So I really do think that debt's the way to go if you're good at what you do. If you have good quality deals and you're good at turning them around, debt is the way to go. Your performance will be rewarded. If you're not so good and it's your first time, you know, if it takes you longer to turn it around, it takes you 2 years to flip it around, equity is a better way to go because you're not getting that greater return, and so you're not giving as much up to the investor. Whereas with debt, it's a fixed amount you have to pay. And if you perform really well, you make a ton of money. If you don't perform well, you could lose money. Because remember, 12 or 14% interest rate on a 100% financed deal, you know, every year you're losing, again, like 14% of the deal. So that means you need to be performing quickly, you need to be performing well, you need to know your numbers. So yeah, I mean, for sure, to answer your question, there is 100% financing available out there. Lots of alternative lenders will 100% fund your flips with none of your own cash. The other option is you get an 80% mortgage, like 7 or 8% from a B lender, and then you go raise the 20% on Instagram or wherever from your friends and family. Someone lends you the money to do the deal, secured against the deal, they put a second mortgage on it. Boom, you have a first mortgage and then a second mortgage for the down payment. Then you sell it, make a profit, pay everyone back, pay them the interest, and then whatever profits left over is yours. That's the way to do it too. And there are lenders like Caliber Mortgage that will do that for you. So yeah, cool. Next question is, lost my spot. What do you think of the condo developers splurging $1 billion on those 8 cities? Yeah, so I was talking about that a little bit earlier in the stream about some of the developers and the bigger funds coming in and spending a bunch of money. They are targeting London, Ontario. That's one of the cities that they're going to buy a bunch of properties in. It's good, I think. It's overall good for anyone who has properties. It is going to create a supply and demand issue a little bit, unfortunately. Reality happened. Yeah. Drew says, hey, I've heard that it is harder to buy property under an incorporation versus your personal name. Is that true? Drew, yes. I mean, generally speaking, harder, no. Is financing more difficult under a corporation? It can be. It can be. In my case, because I have so much going on in my personal name already, and like I have a dozen properties in my personal name already, it's very difficult to finance in my personal name. There's a lot more paperwork and boxes I have to check. So for me, it's easier to buy in my corporation, way easier. But financing terms are cheaper in my personal name than versus my corporation. Typically that's the case. Typically in your personal name, it's more affordable to borrow and slightly easier. It depends on who you are and what your circumstances are. I think if you're just starting out, buy personally. If you've got a few properties already and it's getting complex, start doing stuff inside of a corp. My thoughts. Depends on your income brackets. You have to talk to your accountant. There's a whole bunch of factors that come into play. But generally speaking, CIBC, as an example, will do residential personal mortgages into a property in a corp, 5 properties in a corp, and 5 in your personal name. So CIBC doesn't care. Other banks like Scotia, don't want anything to do with properties inside of a corp with residential mortgages. So it just depends on the lender. Hopefully that helps. If you were to compare two cities against each other, If you were to compare two cities against each other, what would the key success factors for you to choose? You said, how do you go about stocks? Okay, these are two separate questions. So I would say there's so many factors that come into play when I'm choosing a city. Typically, the main factor I'm concerned with is, again, like employment statistics for that area. So I want to know, what do people do in that town? What's the employment rate like? What's the average income look like? What's the median income look like? Is there a pool of tenants that, for instance, like here depending on which area you're buying in, there's an area where you could target all people working at Western University who are well paid. Or by the hospital, you could target nurses and all the staff that work in the hospitals that all make like, high 5 figures, close to 6 figures. You could target that market and buy properties in that area, targeting the hospital, and you'd have a different clientele than if you bought in, EOA, trash, where you're dealing with like the bottom of the barrel, right? The working class, minimum wage type folks who are just struggling to get by and typically are dealing with substance abuse issues, multiple domestic issues. It's just a different class of tenant. Not that there's anything wrong with that. There are obviously people in that group of tenant that are awesome too, but you get more and more prevalence of the substance abuse and the damage to the unit, and it's just more prevalent. Poverty tends to be a leading cause of mental illness, drug abuse. They're strongly correlated, right? So ideally, you're picking a tenant class that's makes the most sense. You got to remember that in the buildings that cater to the C and D class tenant can be turned around. They can be fixed up and repaired, and you could target in that same area potentially a B class tenant. And so just because the building is currently targeting D class tenants doesn't necessarily mean you need to keep running the business in that way, right? It's a business at the end of the day. And I think that, getting into that property management space as a landlord, you have to consider fit compared to ROI, I think is the main metric that I would use. So those D-class buildings will sell at cap rates much higher than those A-class properties. You're going to get almost double the return on ROI on your money buying those kinds of properties. But you're going to deal with triple the headaches and double the damages to the units and a lot more vacancy and turnover and issues at the property. So it just depends how you value your time. I was okay taking on some of those properties halfway through my journey, right? Today I'm not okay with those kinds of properties. I would happily take a lower cap rate with less stress. That's me. I like the key location now. I don't even want to take on. Someone calls me with those projects that need a lot of, that are really rough. I don't even want those projects anymore. There was a time in 2018, 2019, that was all I was buying, was those trash tenants, trash properties that needed a lot of love. And, someone's been kicking the can and being a scumlord, or what do you call them? There's a name for it, but it's eluding me. But basically someone who's not taking care of the property and not being a good landlord. Slumlord, I think is the word. I was buying those kinds of properties. And if you give those properties the attention that they need with the current clientele, you're just wasting your time, unfortunately. So the only way to really turn those buildings around is to renovate them and bring them up to speed and bring in a quality tenant, paying a fair rent that has to justify the price. Someone just said, G Greedy said, I like the trash, makes me money when I fix it up. There you go. So that was a play for me too for a long time. That was my MO when we were buying a lot of properties. But I started buying only in good areas. Like my first properties were near Western University. I only bought in North and West. I was actively in 2016 against EOA, East of Adelaide. I was against the old East Village that was up and coming, McKeever, and all those guys were buying there. And I was like, you know what? I don't see the value here buying in a trash area. It gentrified, but I just didn't want to be a part of that. So for a long time, up until I retired, I think, I was only buying in key quality areas. That was my strategy. I pivoted because I needed to buy, we were looking to buy 50, 60 properties in a year, and there just wasn't enough quality deals in the market with the crazy appreciation we were seeing. And so, I started to buy outside of my key areas, and I did it because I was focused on making a profit and scaling. So, yeah. Okay, next question. Next one was, how do you go about stock selection in respect to fundamental analysis? You mentioned don't chase premium, but it's hard on safe companies to make 1% per week. Yeah, I mean, 1% per week is aggressive. That's a 50% annualized return. No one can keep that up for forever without taking some significant risk that will eventually ultimately lead to a lesser return in that year that it corrects. The way I try to do it right now is I'm looking at companies that I want to own 5 and 10 years from now, solid companies, and then I'm typically saying, okay, on a down day, that's when I'll sell my put. That's when I'll, on the big red days, that's when I'll agree to buy stocks 20% below their current price. Typically is where I'm looking, 10, 20%, sometimes 30% below the current price is where I'm typically looking. And then what I'll do is on those high green up days, I'll put a ceiling cap with a call slightly on the same day or slightly after when I have my put. The reason for that is I've now created a band, and it's set up so that if it stays within that band, I make max profit. The worst case scenario is it goes all the way down and I get assigned those shares at 20% discount. Darn, now I got shares in a company that I like at a price that I was okay paying, but I get all that covered call premium for free. And then once I own those shares, then I'll continue to sell covered calls at a price that's a nice profit on those shares that I'm okay giving them away at. And either I hold the shares, collect my dividend, and collect the covered call premium, or my shares get called away and I make 15% and I start again with another company. So I try to sit in a situation where over time I'm guaranteed to not lose money. And that's been my focus, is not losing money. It's more important to me not to lose money than it is to make money. So that's been my focus. And how do I select stocks? I like stuff that's strong cash flow. I do have some stuff that's growth focused. It depends on which segment of my portfolio you're kind of analyzing, right? I have a different ethos or investor profile statement for different parts of my portfolio. Am I perfect? No. Like I've been caught chasing premium too. On AMC, I was chasing some premium, made 10 grand chasing premium on AMC. Actually at the peak, I shorted it. Now with the spread, I shorted it. So I was doing bear call spreads at 145. So if AMC stayed below 145, it was between 120 and 145. So if it was below 120, that's considered like max loss, which is defined. I lose a couple of bucks a share. If it went above 145, then I'd be screwed. So I was kind of betting that it doesn't get that high. Yeah, I mean, those are risks I was taking. I think that AMC's turd, so I would continue to roll that spread until I'm right, because eventually I will be right. It's trading at a multiple way higher than it deserves. So yeah, I mean, I often will make those Michael Burry type, not naked, but covered spread trades with a long-term aspect. And there will be a down day where I'm right. There'll be a day where AMC's down 20, 30%, and I'll just cash out and I'll make a bunch of money and I'll be good. And so, there's so much volatility. It's hard to be wrong all the time, right? So I've been finding those high volatility stocks. You don't bet the farm on it. Maybe 1% of your whole portfolio. You can play around with that stuff, have a little fun. But yeah, it's not the majority of my portfolio. And I don't know, my philosophy is always evolving. I'm not perfect by any means. I do find that it's fun to chase the premiums, but you gotta try to avoid that. Try to avoid that greed. Okay. Good evening, Will. Good to see you on. William, how you doing? He says, Mike, my question tonight is on fire. How did you stop yourself from staying at your job a few more years for a few more dollars? Did you know your next move before leaving your job? I wrestled in 2019. I hated my job. 2016. In 2016, I hated my job, and that's why I decided to quit. It was December 2016. I officially had my last day. I think it was in February 2017. So it's been 4 years since, more than 4 years since I've had a job. But at the time, I was a millionaire already, and the real estate market hadn't really appreciated a ton yet. And I don't even know, was it 14 properties? Something like that. It was like a small business. And I thought, well, if I sold my whole real estate portfolio today, I was 4% safe withdrawal rate. I was good to go. I was also house hacking, which is another layer of resistance against having to go back to work. And then I figured if I just continued to run the real estate business, then I was generating 3 to 4 times. I mean, like real estate business, like it was passive, owning rental properties, 14 rental properties or 15 rental properties, whatever I had at the time, it's maybe like an hour a week a property when it's stabilized. So that was like 15 hours a week. I was thinking, worst case, I've got lots of time in my hands. I'm young. At the time I was just turned 24. So I was like, I'll be fine, So that was kind of how I rationalized it. But yeah, could I have bought more properties? Yeah. I was thinking at the time my job had maxed out what I could buy. There was no more financing I was able to get. I was tapped. And so there was no more that I could do. My job was only providing value and that it could help me to buy more properties. And so as soon as that utility for my job was done, I was like, I've been here 3 years and there's no more growth in this role for me. My promotion every year would be like $5,000, $6,000, $7,000, maybe. If I get promoted to manager, the next level up above senior manager, there wasn't enough. It just wasn't worth it for me. I was financially independent. Yeah, but I knew myself, and I was like, I know my time's worth a lot more than what I'm being paid at my job, and so it was easy for me to break the handcuffs. I hated what I did. So yeah, for those who are just struggling out there with, leaving, the more you make from your job, the harder it is, I think, to leave. But if you can get all those mortgages from your job before you leave, open those lines of credits, that'll pretty much tap out the value of your job, and then I think you'll be just fine. Just fine, William. I find myself increasing my number all the time to pad my lifestyle into a couple more years. William, I think you're thinking that you stop earning as soon as you quit your job, but typically what happens is something else goes to fill in that time, right? And so I think you'll still be productive. Even one flip a year would probably replace most of your day job income for the average person. So there's always other options out there that you can tackle and pursue. And the worst case scenario is you're wrong and you go get a job somewhere. Like, you try it for a few years, it's an awesome couple of years, and you're like, hey, I'm not an entrepreneur, this isn't for me, I don't find any motivation working for myself, I need to be chained to a desk to get work done. If you're that kind of person, I think you're a minority. But if you're that kind of person, you always just go get a job again. Like, not the end of the world. I think most people will realize that they'll earn more not being shackled to a desk. The majority anyway. Or they'll just enjoy their life. And it's not about how much how much money you have. Who cares how much money you have, right? Yeah, money isn't everything. Money doesn't make you happy. Money is necessary to have a good life. And I think it's like gas in a car or oil in an engine. You need it. It's necessary. You need a certain level of it. But after that, you don't, more oil doesn't make your car go any faster. More gas, once your tank's mostly full, it doesn't, help you in any way. It can be fun, to have more money, but I don't think it doesn't really increase your quality of life. And studies show that after a certain level, the incremental gains in happiness are lesser over, I think it's like 150 grand a year. The research always said 70-something thousand a year, but I'm seeing more and more it's maybe inflation adjusted, seems to be 150 grand a year. There's diminishing returns. You're still happier. People are reporting they're happier the more they have, but it's diminishing returns. Have you dabbled into commercial real estate? A little bit, like a 7-plex, 6-plex, that kind of stuff, that had a commercial restaurant in it. And I've, dabbled in like a laundromat. We had a laundromat in our 4-plex. So I've had some commercial stuff. It's not been my primary focus. It's very hard to find a commercial tenant, and it's a different type of business. It's a beast. Next question was, Mike, are you still buying businesses? I'm actively always looking for the right opportunity, but I'm not so actively looking that I'll buy something that doesn't meet my metrics. It's hard to find. Maybe every couple of years you'll find the right thing. Do you think the stock market being so overvalued that we should expect lower returns in the next few years? I don't know. Who knows? The way they're printing money could continue to grow for a while yet. At the same time, let's think. To answer the other part of your question about the stock market. Noah, we gotta be out in a minute, okay? Daddy, be out in a minute. It's almost our bedtime, guys. I gotta wrap it up here. I'll do like 5 or 10 more questions. Sorry, expecting lower returns. I don't know. I don't know what the future holds, to be honest. Are we overvalued right now? It depends on what metric you use. I think a correction is, there are natural corrections that flow in the market. My daughter really wants me to hang up this call. Um, do you have the London land appreciation stats for the last month? Ken, last month is actually down, as far as I understand. There was more listings and number of days of inventory is increasing. So it actually was not good, actually. But I think June it's starting to pick back up. I'm seeing a little bit more of a pickup. But yeah, there was a big deceleration in real estate stats. What is your high-level plan with your investments to reach $100,000 a month? Hang on a sec. No, sweetie, daddy's live, okay? Can't come out, okay? I got 5 minutes. 5 minutes. I love you. Yes. Oh, my girl, she's so cute. It's so hard to say no to her. Oh, guys, she's at such a cute age. She's almost 2 in a couple of days, really. My middle child's almost 2. And she's so cute. It's so hard to do these streams and she just wants her daddy all the time. Okay, sorry, you were talking about a question about high level plan, reach 100,000 a month. Ideally that's as passive as I can get it. I think probably I'll build up one of the legs of getting to where I want to be is, and I'm not far off from 100,000 a month. It's an achievable goal for me, but definitely before 30. I think that one of the legs is cryptocurrency, crypto mining. There's some businesses within the crypto space that I think would be really cool. I could build a business like that. And the cool thing about businesses in Canada is, my wife and I can sell that business after we've already got a business going that, I'm doing that kind of stuff. But you can sell a business. You've had it for a couple of years. I think I've had this one. 2 years will be this year. So I need like 3 or 4 years, I think, of growing this business to get to a size that I can actually sell it. But I could sell that business for, say, even $2 million, and $1 million each one is completely tax-free, capital gains tax-free, one-time, lifetime exemption. Both myself and my wife, every person can claim it. I think it's a little over $1 million now. I checked the exact number, but around $1 million you can take in capital gains tax-free on the sale of your eligible business. So my goal will be to take advantage of that in my life. That's part of my goal of my master financial plan. And I think everyone should take advantage of that. Everyone should build a business up and sell it. So that means that, 2 spouses can sell it for $1 million each. It's very, very important, I think, to maximize every sort of angle, and entrepreneurship is one of those angles to building wealth quickly. I've exploited the real estate angle. I'm still exploiting the real estate angle. It'll always be a part of my path. I want it to be less of my path as my net worth increases. I think it's not reasonable to have, even half of my net worth in real estate is a lot of work. And so it'll be less and less over time, more and more passive to meet the lifestyle goals. And I think at 100,000 a month, if I'm still in my 20s with $100,000 a month, that's my goal. I really can't see a real need to push or to do anything. Why at that point? What can't I do on 100,000 a month? Is there, something that I actually want to do? And I can't think of it. Can't think of it. Feeling blessed, Okay, the next question's down here. Let's see. 34 likes. Yeah, that's right. William says there should be more likes. Agree. There should be. For everyone watching, you should hit that like button. Ram says, Kraft Heinz talking about raising prices on their soybean products like mayo because their input for soybeans is up 100%. Yeah, right now it's, kind of chewing into the margins, right? Do you plan unvaccinated? I'm not going to talk about that on air, but maybe. I think it's stupid to have a vaccine passport, regardless of if you're vaccinated or not. I think that it sets a dangerous precedent. So I don't think it's going to come to fruition, but who knows? Generally, I think those who are at risk should get the vaccine. There's clear data that those at risk will benefit from the vaccine. Kids, if you're under 12, you should not be getting the vaccine. That's stupid. If you're in your 20s, or if you've been exposed already to COVID, you're positive that you've been exposed to it. I know lots of people that have been exposed to it. My property managers had it, and I'm not going to say if I've had it or not, but lots of people have been exposed to it and recovered, and they're probably their natural immunity is just as strong or stronger than that of the vaccine. And I don't think it's necessary to get the vaccine if you've already had it and you've built up a natural immunity to it. And given something like a third of people have already been exposed to COVID, is what they're kind of forecasting. A third of people don't need to get the vaccine, in my opinion. But I guess get the test and see if you have the natural antibodies. Next one was, does it make sense to buy a turnkey duplex then go through the BRRRR? Well, you can't BRRRR on a turnkey duplex. It doesn't work that way. The idea of the BRRRR is you're buying something that's not turnkey and you're renovating it and you're increasing the value and increasing the rents. So a BRRRR is not a turnkey. I think there's confusion there. And the two strategies are totally different. Though people buying turnkey with this kind of appreciation are getting full BRRRRs because of the appreciation in the market. They're not BRRRRing, but they're getting a full refinance, cash out refinance on their capital. So everyone looks like a hero who bought real estate in the last even 12 months, right? Just putting deposits on new builds before Corona made great returns. Yeah, I mean, that's true. Michael G, yes, I do. Still actively looking where it makes sense. I've had like 5 opportunities come across my desk. I'm also actively building out 2 of my own businesses right now that I plan to sell at some point. But yeah, I mean, I guess technically this is a business too. So I have 3 businesses going, but I don't really invest actively in this business or this brand. I invest a lot of my time, but it isn't really, my Rosehart brand isn't really saleable and it's not being monetized. So Steven says, hey Mike, for business owners who want to buy an investment property potentially for running their own business, would it be best to buy under your name or under a company name? It's hard to give you specific advice, Steven. I think, again, it depends on your situation. Like I said earlier, it's hard for me to give, specific advice when I don't know your situation, right? For some people, it could make sense. For other people, it makes sense to have a holding company that owns that property as well. And you could have a series of tiered structures that could make sense with an active and a passive corp, a management corp, so to speak. You could just buy it personally because it's a lot easier and a lot less, administrative and legal costs and accounting costs. So it really has to be a huge tax benefit to drive you to that. So typically you've got to have quite a few properties or a high income already to even consider the corp route, or some reason to consider the corp route. Generically, I would say to start buying properties in your personal name. Finished basements or additions. Basements, yeah, I think they're pretty much always worth their investment if you're careful with how you renovate. How do you go about finding homes that have problems with the city? There are lots of ways. You could pepper flyers. You could reach out to, I don't think the city would probably give that to you, but you could try. You could reach out and say, hey, is there a list of people that have long, tall grass orders or whatever? You could probably get that. In some cities you can, if you talk to the right person. Or just drive around the city and look for those kinds of properties that look distressed, that have trash, and find out who the landlord is and go talk to them. Drop off flyers, that kind of stuff. You mentioned in another video you're planning to sell a property a month. That capital gains tax will be huge. Are you selling ones under your corp to get 12% instead of 54%? Best tax tip. So real estate doesn't qualify for 12% tax unless you have a business with more than 5 full-time employees. So real estate is always passive, always at 55%. In your personal name, no, not 55%, it's half of the capital gains at 54% or whatever. But no, yeah, there will be a large tax burden in selling the properties off. I'm fully aware that I will pay a lot of tax in selling off the properties, but that's okay. I factor that into my plan, and I would rather have the money net of the tax than have the property and the headaches. I will generate more on the capital invested in the market than I will in the property, especially because a lot of them, I have to refinance all the properties to get my equity out, and that's a huge endeavor in and of itself. So part of my plan is to get rid of some properties in my personal name as well. What's your opinion on flipping in scenario with no inflation? I plan on building my wealth through the next years through flips, so I want to plan for every scenario. So flipping counts as active income. it makes really good sense to flip inside of a corp. Never flip property in your personal name. That is the one exception. If you ask me how do you flip real estate, if your plan is to dispose of the real estate in the last, in the next like 12 to 15 months, do not buy it in your personal name. It is much better to buy it in less than 15 months. 100% buy it inside of a corp. Flipping has fantastic tax advantages inside of a corp. Platform for trading is Interactive Brokers, Derek. If you go on my Instagram, look under my saved stories under options trading. There's a link. If you go back in my videos 4 or 5 videos ago, in the comments, I pinned a link to Interactive Brokers. You get free shares. I get free shares. Sign up with them. They have the cheapest margin by far. They are the best trading platform, bar none, in Canada. Their margin is fantastic. Just for a number of reasons, they blow a Quest Trade and all the rest out of the water. Not even close. And I had a Quest Trade account. I closed it down, moved it over. Use my link or don't, but you can get some free shares if you do. Mike, what are the 8 cities they're buying in? I'd have to get the link and show it to you. I think there's like KW, Cambridge or something. I don't know. I'd have to look. Windsor was not on that list. I've noticed most Ontario YouTubers are saying that Olympia Trust for RSPs, TFSAs, OT say they're not available in Ontario. Who do you use? They are available in Ontario. As far as I know people who are using them here in Ontario for deals here in Ontario. So I don't know. There's lots of other, there's a million other trust companies, a ton of them. I had a list at one point of like 15 on a document somewhere. I compiled a list of all the people doing it. So even lawyers, some lawyers can do it. So yeah. I did those questions. I don't think I missed any here. You mentioned once the compute jobs for GPUs in the fall coming. Can you share a link? It isn't out yet, but my understanding is Kudos is going to be launching that sometime in the fall, but who knows when exactly. What book do you recommend? So a nice one just to start, like basic passive financial independence investing is, I think it's Money for Nothing by Derek Foster is a decent entry-level one, just like basic stock investing. And then Tasty Trade is a fantastic website to start learning about options trading. It's free. You're right, debt-to-income ratios are annoying. What's the shirt? I don't actually know. Let's see. Mission Youth. Mission Youth is the shirt. If you don't mind the range of your income before you quit your full-time job. Oh, what was my range? So I don't even know. I have videos. If you go back on my channel and watch my old passive income videos from like 2017, 2018? Yeah, early 2018, I did some videos. I think I was making 10, 12,000 a month, something like that. In a worst case scenario with a lot of vacancy, I think I'd make half of that. So I was more than covered. How many properties do you have before going through partnerships? Again, like 17 or 15 or something. I did the lone wolf style, for a while. How old am I? How old am I, guys? Do the math. Retired at 24. You guys can do the math. Is there a way for Americans to invest in Canadian real estate? Yeah, you have to put more down, but sure. Bro, you should upgrade your wheels. So you're talking about wheels. You probably saw my Instagram stories if you've been following me at Mike Rosehart that I was driving the BMW last week, and so there's a story there. But that car is partly mine. Doing a car share with someone, and yeah, long story. Hope you're doing well. David says, grew up with not a lot. That's true, I did. This is true. Good points, thanks. Yeah, my children are gonna grow up totally different. Do you have any concerns about keeping in mind? Yeah, I mean, I want to teach my kids that hard work is important and the value of a dollar and all that kind of stuff. I think I got most of these questions. I gotta go. My daughter's screaming here. So, William, thank you for the fist bump for $3.99. Appreciate that. And thank you for the $1 Raz. Appreciate that too. It all helps. Every little bit keeps the channel going and keeps the lights on. Everyone, it's been a great hour and 5 minutes. I've appreciated all this time with you guys. If you want to keep engaging with me, follow my stories at Mike Rosehart on Instagram, and I'll see you next week. And if I didn't get your comment or I missed it for some reason, and you want to get your question answered, just put it in the comments after this in the playback. And if you're watching the playback, thanks for watching. I appreciate it. It's great to see you on and giving me your time. I appreciate it. So jump in the comments and say, hey, enjoyed the stream, or whatever. Good to see you, Mike. Something like that. That'd be cool. The secret to unlocking a wealthier you is 3 levers: spend less, earn more, and maximize returns on the difference. Have a good night, everyone. We'll see you next week and on Instagram.